Welcome to a new video. In this video, I'm going to explain to you how to make investments and not have to pay taxes. All right, guys, I hope you're excited. So, one thing we worry about when we start investing is like, hey, we worry about taxes. I'm going to show you an account that you could invest in and you will not have to pay any taxes, right? So I've been using this account. It's been very beneficial to me, and I want to share it with you. All right, guys, so, just realize wherever you purchase, right? It could be a mouse, right? It could be cologne, right? Whatever you purchase, realize that you will pay taxes. For example, if you go to the store, you buy some clothing, right? The government takes tax from you, right? They need to regulate the city, they need to pay for expenses, to get people from one location to another. They need to maintain the area, so you will pay taxes, right? You pay also taxes on housing. So there's taxes everywhere. It's really hard to not do any, purchase something and not be taxed. It's very difficult, right? Especially from a job, right? When you're working from a job, you work for a company, at the end of the 2 weeks, after the deductions and after the government has taken taxes from your account, you get paid, right? So you're always getting taxed. Well, the government wants to actually help people within their city by giving them an opportunity to make investments and not pay taxes, okay? So this is actually a tax-free saving account, okay? And it's free, it won't cost you anything. Anyone can open this up. It's very easy to do, it's very quick. And yeah, so, because you're getting taxed in so many different areas in your life, right? Like in housing, in shopping, like for a car, for your cell phone, for all these different areas. Well, the government was nice and actually let you not pay taxes in this one account, right? So why not take advantage? The name of the account is called a tax-free saving account, right? And so that's in Canada. So that's what it's called in Canada. In the United States, it's called a Roth IRA. It's the same exact thing with a bit of differences, and I'll explain exactly what the differences are. Okay, so how the tax-free saving account works is basically every year the government allows you to put a certain amount of money inside this account and you will not be taxed on it, right? In Canada, it was introduced in 2008. So from 2008 up until 2020, you're allowed to make, so in 2008, I believe it started off, with certain, every year has a limit. So in 2008, let's say it was like 5,000. In 2009, it was 5,000. And then in 2010, it was like 10,000. So each year you were allowed to put in a certain amount and you would not be taxed. So 2008, 5,000, 5,000, 10,000, okay, for example. So that would be 20,000 in like those 3 years. So starting from 2008 up until 2020, a total of $69,500, right? So if you have never contributed any dollar to this account, well, you can put in the total amount into the account and you will not be taxed, right? How exciting is that, right? So just imagine, like, if you had this $70,000, you let's say you doubled it, right? So it turned into $140,000. So basically, if you had $140,000, you would not pay any taxes, right? How crazy is that? Yeah, so in Canada, you're actually allowed to invest the full amount. If you never contributed to this account, then you can put in the full amount. It's cumulative. Every year, you can put in the limits every year, and you can put in the total amount in 2020. So obviously in 2021, you'll be able to pull, the limit will increase from 69,500, to whatever the government decides next year. So how exciting is that, right? Like, let's say you put in 10,000, it turns to 20,000. You put in 10,000, it turns to 100,000. You would not pay taxes, right? So the way I use it, basically, I take money from my personal account and I send it over to the tax-free saving account. You need to be aware that you don't pass the limit. So $69,500, if you never invested ever in this account and you put in, like, let's say you put in $69,500, well, you can't pass it because then there's a penalty. So you want to make sure that you don't pass that. if you have been contributing right consistently, in the years, you just need to make sure that you're not passing that. So that was for Canada. Now for the United States, the way it's a bit different is it's not cumulative. So in Canada, we really are benefiting from the fact that we're able to put in the entire sum if we've never contributed. In the United States, it's not like that. So you have to make sure the year that you are in, so let's say it's 2020, you need to figure out what the limit is. So if the United States government allows you to put in 5,000, well, that's the only amount that you're able to put in. Okay, you can't put in more than 5,000. You can't put in 10,000 because you'll have to pay a penalty. So every year there's a limit and you can't pass that. So that's the research, that's the information that I found from the research that I did, that it was not cumulative. If you guys do find information from maybe from your state within the United States that's different, that allows you to do it, well, I want you to mention that in the comments below, to help anyone else in the United States. But like I said, from what I found out in the United States, you can't put in the entire amount. You need to put in only the amount that's that's limited to that year. I just want to give you like a brief overview of like how it works. So basically, you take your money, and so this money that you got, it's most probably going to come from a job, right? Because that's our source of income. Mostly everyone gets their source of income from a job, right? So realize that your income from your job has already been taxed. Like I was mentioning earlier, right? Like that you're working for a company takes away the deductions and the government taxes you, then the net income that you receive, that's already taxed. So that's why when you take that money, you put it into the tax-free savings account, you're not gonna be taxed anymore on it, right? And if it grows, let's say for example, you put in $1,000 for that month. Well, if it goes to 2,000, you don't pay any taxes on it, right? I'll make a detailed video of exactly how to do this step by step. So if you actually want that, let me know in the comments below. But yeah, I'm going to be doing it in terms of a step-by-step guide to make it more easy to understand. But in this video, I just want to give the overview picture. So basically, take money from your income, you put it into this account, and then you use that to buy shares or stocks from a company that you really believe in. Currently, what I'm using is I'm using my personal checking account, and the bank that I'm using currently, it's TD. Basically, whenever I get money in that account, I transfer it over to my Tsfa account, and then I use that to purchase stocks, right? I purchase a stock, and then I wait, for it, I let it grow. Like it's like a seed, right? You plant the seed, you give it enough water, enough sunlight, you put it in the right soil, and then you just let it go. You have to be patient. In the next video, I'm going to be showing exactly what I do. And like I said, I'm not a financial, like a stock analyzer or anything. Like I don't have any background in finance, okay? So, and I do things very simply because I just want to make sure I make money. I don't want to lose any money. So like when I take a decision to invest in stocks, like I don't want there to be a risk. I do not want to lose money. I've worked very hard for it. And so that's why I put in a lot of effort in my initial research. There are though transaction fees. So currently I'm using TD, and like I said, for every transaction that you have to pay like $10. So which is why also that I don't really do a lot of transactions. I just purchase it in big quantity and I hold it for a long time. There are other platforms where you can trade and you not have to pay any commission fees. I'm starting to get into that, but like I said, I've had my success and I didn't do a lot of trading. I just purchased, held, and the money just grew automatically. So now I'm going to be explaining what the difference between an Rsp is and a TFSA, what the difference between the two are. So Rsp stands for Registered Savings, Retirement Saving Plan. Sometimes it's also abbreviated as Registered Retirement Saving Plan. So it's the same thing. And I'll tell you what the difference between the two are and which one you should start investing in first. So let me give you an example. Let's say you're working at McDonald's and every week you get paid $500, okay? So after 2 weeks, you get your paycheck, it's $1,000, and let's say that's your net income, okay? So you receive that into your bank account, and that was after taxes, okay? So now when you take that full amount, that $1,000, and you put it into your tax-free saving account, the TFSA, that money has already been taxed, so the government's not going to tax you. Okay, so that's what's a tax-free saving account. So from your job, it got taxed. You take that money, you put it in, so the government doesn't tax you anymore. Okay, so that's why it's safe, and you can invest any profits you make. There's no taxes in there. So how's that different from an RSP, which is retirement saving plans? So you're working at Walmart. So let's say you tell Walmart that from your paycheck you would like some of the income that you're getting, you want that to be contributed towards this RSP, this retirement saving plan. And so in Canada, it's called a retirement saving plan. In the United States, it's called a Roth. Okay, it's the same thing. So it's not the Roth IRA. Roth IRA, it's a TFSA, which is Roth IRA is the same thing as tax-free saving account. So those are two different things. All right. So I hope it's not confusing. I know there's a lot of abbreviations. So once again, your retirement saving plan. So you tell your company to put a certain amount into that account every week from your paycheck. So you never get to use that money, and it never turns into income. So they take that amount and they send it over into that account before it gets taxed. Once it goes into that account, you can store it up, and you're allowed to only take it out after you take your retirement. Okay, so let's say it turns into $30,000. Well, at retirement, you can take that out. And when you take it out at that time, then the government's going to tax you. Okay, so that's the only difference. So tax-free saving account, you've already been taxed, and then you're allowed to take that money now, put it into the account. Retirement saving plan, it's money that hasn't been taxed. You put it away, and then once you take it out, then it gets taxed. So that was the difference, right? Look, my suggestion to you is to max out the tax-free saving account first. Okay, max it out completely. Don't even think about your retirement saving plan yet. Okay, how do you decide which one to choose to invest in first? Should you only invest in the tax-free saving account, or should you only invest in your retirement saving plan? Well, here's my suggestion and what I suggest. If you think that in the future, like when you're older, you won't have a way of making income, then you can think about retirement, right? But if you're young, if you're driven, motivated, and you're making income right now, and you're sure that at the end of you're not sure, but you're determined that you're going to make something happen, so that even when you're older you still have income coming in, well, then you don't need to really focus about retiring yet. Okay, what you need to focus on is earning enough income and then using that for investments, and that can help you with your lifestyle, not only now but also in the future. So think about retirement and putting money into the retirement saving plan. It's only when you think that you're going to work for like 30 years, and after 30 years, obviously you're going to be old. You might have some trouble working, so you're going to have money saved up that's going to help you sustain your life at that time period because you can't work. So that is the difference between the two accounts. So I hope that helped. I hope it's clear now. If you guys have any more questions about a tax-free saving account or RSP, please let me know. Let me know if you liked my definition and how I think of it. If you agree, and if you don't, let me know why. I would love to hear your opinions. Let me know, what are you doing? Are you investing in a tax-free saving account or a Roth IRA, or are you investing in a RSP, retirement saving plan? Which one are you doing, and which one do you think is beneficial to you? You can send me a message on Instagram. I'll leave my link at the bottom, so you can send me a message, or you can just leave a comment in the sections below. You can ask me any questions. I'll be happy to guide you and share my experience. So I've been doing this for 3 years, and I've learned a lot. I've made a lot of mistakes. My goal is now to put up one video on finance every single week. I want to be doing that a lot more in 2021. So if you guys have any topics you want me to cover, if you're interested in a couple of things, let me know. If you're a beginner, or maybe you're just having trouble with some things, well, let me know and I'll be happy to guide you. Just look out for more videos like this. Please subscribe if you want more videos like this, and you'll be notified every time a new video comes out. So I hope you guys enjoyed that. I'll be making more videos like this. Let me know what videos you like, and I'll be happy to do them. All right, guys, so that's it for me for this video, and talk to you guys on the next one.